Thanks for joining us today on Market Call. I'm Morella Fernandez. Eric Nuttall with us on the show, partner and senior portfolio manager at Ninepoint Partners. He'll take your questions today on energy stocks. Here's how to reach us. 1-855-326-6266. If you want to call in, you can get your question through an email, marketcall@bnnbloomberg.ca. Eric, good to see you.
Great to be with you.
So we are getting towards the end of the year. When you look back at the energy sector, how would you characterize the year for energy stocks?
It's been a spectacular year. I think far better than most people would have thought in the year entering 2025. Here we have oil down 19%, and the fund that I manage, the Ninepoint Energy Fund, up 24% year to date. And so I'm very, very happy with the year. I think there's a few reasons why we've seen such a massive dislocation between what energy stocks have done and certainly at least what oil has done. We are at the beginning, I think, of a realization that the biggest source of incremental supply, U.S. shale, is reaching a permanent plateau to decline. And what we're told is the big banks are seeing a significant increase in funds flow and attention from U.S. investors into Canada. We're blessed with companies with decades worth of drilling inventory. And so here, U.S. investors typically only know, the big three shale play companies. Companies have depleted their best rock. They're sitting on 3 to 5 years of stay flat inventory. And sure enough, here we are north of the border, companies trading at a discount. We have better imaging from the federal government, at least in terms of their support. We have incremental takeaway capacity. Canada can add a further 800,000 barrels per day of takeaway capacity on existing lines over the next several years. So we have seen a big dislocation for at least oil stocks to the price of oil. Natural gas has been strong this year. We've benefited a lot from that as well, and we're quite bullish both on natural gas as we enter into 2026, and the time will come as well for oil. We think we're on the cusp of the next mega bull market for oil.
Okay, I want to talk about natural gas for a moment because, as you mentioned, prices are beginning to rise. What has led to that? And when you look ahead to possible stimulus for 2026 in nat gas, what do you see?
There's three big reasons for the rise. First is there's systemic increases owing to the increase in LNG capacity, both in Canada and the United States. Canada new this year, we're now exporting 1 BCF, soon to be 2. The United States is exporting 18 BCF a day. That's going to grow to 30 by 2030, so over the next 4-ish years. Secondly, there is an increase in power demand in areas where data centers are being built out. Areas such as Texas, power demand is up 5.5%, which from a historical context is remarkably strong. U.S. power demand was growing by about 0.4% for the past 2 decades. And thirdly, thankfully, the reason why I'm not in studio is winter has finally arrived. We have the coldest December in 10 years. Forecasts continue to be at least indicative of at least a normal weather. So we've seen an increase in the natural gas price from that. Broadly speaking, I would say natural gas has gone from being a bridge fuel. It was going to bridge it to some future where, we were going to live off of solar panels and windmills. And it's really become a foundational fuel where GE Vernova, they make gas turbines this morning. They reported this morning. They spoke about clear visible growth out into the 2030s. And it's all going to come from natural gas.
All right. The AI build-out is definitely, I'm sure, helping there. Eric, we're going to take a quick break. We will be back with some questions through email and on the phone. Eric is taking your questions today on energy stocks. Here again is how to reach us. We're back in just a moment. Stay tuned. Welcome back. Eric Nuttall is our guest today. We are going to start with an email from Jeff who says, can I get Eric's view on surge as a nice opportunity for price appreciation and for dividend? Tell me about surge.
So surge is a conventional, typical oil producer in Western Canada, led by Paul Colborne. He founded the company many, many years ago. It's just symptomatic of a spectrum of the market where there's simply a zero care factor. That is the small cap in Canada. Energy remains out of favor. When I say that, and it's funny to say that, performance this year, broadly speaking, has been very strong. I have the best insight in terms of sentiment because we get inflows and outflow data on a daily basis. And gauging by outflows, which have continued for over 2 years now, despite strong performance, the sector is out of favor. As a result, to get significant upside in stocks, I think being wise to where do you want to be on the market cap spectrum? Not too big, not too small. Unfortunately, Surge is just too small. At a market cap of about $720 million, they are simply irrelevant to any institutional investor. And the buying power in retail is not enough, generally speaking, to get it really going. If you pulled up a 10 or 15-year chart, you'd see the stock has done nothing but go down. And so, yes, it's yielding just over 7%. It screens very well on spreadsheet math, but from a market dynamic, I struggle to see how the stock can regain or attain the interest factor of institutional investors. What they should be is an input to a much larger entity. I think there's a few companies now which have the ability to aggregate companies such as the Surge, which nothing to their fault. They've done a good job of drilling good wells, but it's a different market today than it was 5 or 10 years ago in many different senses. And so I think you just have to be a little bit bigger to be more relevant.
All right, let's get to our first phone call then. Sandeed is on the line. He's in Barrie, Ontario. Hi, Sandeed.
Hi, good morning. My question would be for freehold royalties.
Right.
Should I hold the freehold royalty stock? Should I hold it or sell it at the price? Any opinion on freehold royalties?
Okay, thank you for the question. So they do oil, natural gas liquids. They're at 15.05 is where we have them today, Eric.
Yeah, Freehold has done very well. It's up about 20% this year. I believe it is also the top performing royalty company in Canada. It's the largest holding in a energy income fund, which we manage. I also own it personally, exclusively for the income. If you own the stock, you're never expecting to shoot the lights out. This is very much you collect your 7.2, 7.3% dividend yield, depending on the day. That is sustainable down to about $50, $51 oil. And they have enough inventory depth to pay you that for the next 30 to 35 years. We're bullish on oil, I would say, in the second half of next year. We're bullish on natural gas, both from a U.S. perspective. We think $4 is the floor. We also think with LNG Canada ramping up, the discount for Canadian gas is going to shrink. That is all to the benefit of a royalty company because you have no capital expenditure or capex risk. You're solely benefiting from the rise in revenue, which you clip off the top. So this is a name where, again, if you're a yield investor, you're looking for what in my opinion, is a very safe, very steady yield. This is an excellent choice.
Okay, so would you stay in it? I mean, he was kind of thinking, should he sell at this point? You mentioned it's done pretty well. Would you trim at this point?
We own a lot of it, and I continue to own a lot of it. So I can see it through his perspective. I don't sell the stock just because it's gone up necessarily. If you would have bought it because you want the yield, it continues to pay a very, very healthy dividend yield, especially in a world of interest rate reduction. So I think it's still compelling.
All right, let's go to our next caller then. Daniel's on the line. He's in Markham, Ontario. Hi, Daniel.
Hi, Marilla. Hi, Eric. My question is on Advantage Energy. Do you own Advantage Energy, or do you see better opportunities in Expand, Antero, or ARC Resources? And also, Eric, happy rest of 2025. Come more often in 2026 to Market Call, and one of the best guests. Thank you.
Well, thanks very much. Advantage is not a name that we own. They are actually undergoing strategic reviews. That's code for they're trying to sell themselves. The process, I think, is taking a little longer than what people would have thought. I believe there is now a special committee of a few board members that are running the process. And so I would expect Advantage to be sold to a name like a Birchcliff, potentially to a name like a Peyto, or there is also a significant uptick in private equity interest in Canada for reasons that I spoke about earlier before, a realization that Canadian macro is getting better, Canadian pricing is getting better, and companies have a lot of deep inventory. Advantage and I kind of butted heads earlier this year when we had bought stock. They did an acquisition to increase their oil weighting. Fast forward to today, oil is down 19%, gas is very strong, and so and their share performance was very, very weak on a relative basis to their North American peers. And so I look forward to the day where they're sold. I think they'll make an excellent acquisition candidate for another company, ideally and on a creative manner, and to increase market cap to gain relevance with investors.
Okay, I hope that works for Daniel. Let's go on to Gordon. He's in Victoria, BC. Hi, Gordon.
Good morning. Thinking particularly about the Reford project, has the sustainability of Cardinal Energy's dividend been appreciably improved recently?
Okay.
You bet. Cardinal is on kind of, I would say, the cutting edge. They were one of the first companies to do a greenfield, small modular oil sand project. Cardinal now is yielding about 7.8%. They were at a time for the past year leaning on the balance sheet to pay that. Now that the CapEx process is over, they're now be able to sustain that. We have to about the low to mid 50s. It screens, I would say, expensively. I think part of that is Murray Edwards is a significant shareholder, and so you get some of the shine of one of the biggest oil tycoons in Calgary being a major shareholder. I would look at it; it's trading at 8.2 times forward cash flow at $60 oil. Even if you go out 2 years in 2027, it's trading at 7.8 times. So I kind of fail to see meaningful capital appreciation. We are bullish on the outlook for oil. They would have significant leverage to a rising oil price. So if you were to go from 60 to 70, their multiple will compress from 8.2 times to 5.8. So you've got to be an oil bull, or serious, well, not serious, but like an oil bull, and be looking out, I would say, 2 to 3 years to see significant enough upside in this stock to hold it.
Okay, we will leave it there for Gordon. We will take another quick break. Back with Eric Nuttall of Ninepoint Partners, taking your questions today on energy stocks. Here is the number to reach us and the email as well. We're back in just a moment. Welcome back. We are going right to the phone lines. Elliot is on the line in Hamilton, Ontario. He's got a question today for Eric. Hi, Elliot.
Good afternoon. Performing pretty well in 2025. What's your outlook for Spartan Delta in 2026? Thank you.
Okay, thank you for the question. They do exploration, Eric?
They do. So Spartan Delta is a unique company. They're not returning capital back to shareholders. They're not trying to harvest free cash flow. Instead, they were very early in identifying significant upside in the Duvernay. They acquired many, many hundreds of thousands of acres in that play. They've been drilling just spectacular wells. This is an exception that we're making in terms of going into what I would define as a small cap. Market cap's about $1.5 billion. We've actually recently acquired a stake in the low to mid sixes. I think we own 3 or 4% of the company at this point. It is again a contrarian to what we typically want. We typically want low to no growth, maximize free cash flow, use it to buy back shares, et cetera. This is an exception. We do think that there is significant private equity interest, especially specifically from the United States coming into Canada. We don't think there are many opportunities in the United States for private equity to deploy capital, and they're looking at Canada hard. The two plays that they would be looking at is either the Montney or the Duvernay. Spartan Delta is one of the best vehicles to play the Duvernay. They were very, very early. They acquired a lot of land, a lot of potential locations cheaply. They've been slowly grinding away well costs. They've been increasing productivity. And so as the company continues to grow and delineate and explore, I would imagine one day they would be an acquisition target, which we never specifically buy a company for that. But as they continue to grow, we would have them trading at 4.6 times forward cash flow at $60 oil next year, falling to 3.5 times in 2027. A company like this, we would typically put a 5 multiple on. At $60, that would get us an $11 target price, which would be 48% upside from here. And importantly, a name like this, a name like a NuVista as a parallel, you can't buy it with a 1 or 2 year time frame. You're not typically seeing the full upside should you do that when a company is so deep in resource and is continuing to grow production, grow reserves, et cetera. And so it's a newish name for us. You get the benefit of both liquids and natural gas upside.
Okay, that was Spartan Delta for Elliot. Let's move on to Deborah in the Okanagan Falls with a question. Hi, Deborah.
Oh, hi. Good morning. Today, my question's on Tourmaline. My screen is showing the short-term price targets at a low of 62 and a high of 84.84 and an average of 72.44. Eric, where do you see the short and long-term price targets for this company?
Okay, we'll pull up the chart. There we go. 63.43 is where we have it today, Eric.
Tourmaline is one of the few natural gas stocks that we do not own. If you were to talk to large institutions, even retail investment advisors in Canada, for energy exposure, if they don't own my fund, they will own CNQ, Suncor, and Tourmaline. So it's a very well-held stock. As a consequence, there's not as much incremental buying. They're also a company defying, I would say, the zeitgeist of the time, which is they're pursuing fairly significant organic growth. So they've got a CapEx-heavy program, which really mutes their free cash flow, which mutes their ability to pay a special dividend. they'd be yielding now roughly 4.8%. On our math, it's about 3.6% forward. That's using $4 gas. So if you're looking for a yield, there's better names. In terms of capital appreciation, it's already trading at 6.1 times forward cash flow. We think a 7 times multiple is appropriate. That would give us, again, this is using $4 gas and $60 oil, about a $73 one-year target, $79 2-year target. So that's about 15 to 25% potential upside. What I would say is at the current commodity price. There are names. There's an even larger company later, which we see about 4 times the amount of upside, or at least 3 times more upside. So stay with us to top picks in a few minutes' time.
Okay, Deborah, we hope you do that. Let's go on to Paul in Orangeville, Ontario. He's got a question today for Eric. Hi, Paul.
Hello?
Go ahead.
Yes, Vermilion Energy. The last quarter, they showed some improvement. How does it see it in the next quarter?
Okay, that is Vermilion Oil and natural gas play. Have you owned Vermilion before?
Many years ago. We've been a fairly vocal critic of their overall strategy. We felt over the years they were far too geographically constrained. I have an atlas behind me somewhere. I would need it to figure out where in the world these guys are. They had as many as like 12 or 13 different countries that they were in. They're in the process over the past year of consolidating, selling off a lot of those areas, focusing more on Europe and Canada, specifically in the Montney in Canada. It's on our radar list. We watch it. I just don't see it as terribly compelling at the moment. It yields 3.9%. That's not compelling. It trades at 4 times cash flow. That's not compelling. It used to offer you very good leverage to European gas pricing. To my best knowledge, Corrib is now in plateau to decline. So I don't really see the investment thesis in this. If it is tax time, if you're sitting on this stock, I think there are far better names where you don't have a lot of these, potential uncertainties. I've got one later on where they'd be paying you almost twice the dividend yield, where they've got significantly more running room inventory depth, well delineated, and the market cap is 6 times bigger. So it's going to be more relevant. So I would harvest this loss and consider either an energy fund or a top pick later on.
Okay. Paul, I hope that's good for you. Let's go on to Mila, who's calling from Calgary today. Hi, Mila.
Hi, guys. Hi, Eric. It's Mila calling from the oil and gas province of Canada. And unfortunately, our Carney and Liberal government is abolishing or trying to abolish the oil and gas and pipeline industry in Canada. But my equity question is on Baytex. I've held it for a long time. They've sold the Eagle Ford assets in Texas and concentrating in the Clearwater area. But I love your outlook, Eric. You're the king of oil and gas, and your outlook on future price forecast for Baytex for 2026 and beyond. Thank you so much.
Thank you for the question. They're at 426 today.
Thanks for the kind words. Baytex is doing a great job of repositioning themselves. They suffered what prior Canadian companies like Enerplus and even in Canada/Ovintiv did, where if you have assets both in Canada and the U.S., you kind of alienate both sides of the investors. Canadian guys don't know what to do with the U.S. assets. You investors don't know how to analyze the Canadian assets, and you stay in limbo. Baytex also had a debt problem in a falling oil price. So what they've done is they've sold off the Eagle Ford for what I would say, generally speaking, was a pretty good amount. What they're then doing is they're paying down their debt significantly, to a net cash position. They will then use 3/4 of that cash for shareholder return. So over the next year, what you're looking at is $675 million, give or take, of share buybacks. So what I would expect them to do is to finish off their NCIB, so that'd be buyback 10%. I would expect them to announce a SIB, a significant issuer bid, for an undisclosed amount of shares, and then they would renew another 10% buyback. And so that's a lot of buying. The market cap today is $3.3 billion. So you're looking at them buying back roughly 20% of their shares over the next year. That alone, I think, will take the stock close to $5. At that point, they do have, and I say this charitably, I do like the CEO quite a bit, and their Brian Ector, their IR gentleman, but they don't have as much inventory as they need to gain relevance. And so what they need to do is, if they get a better multiple, use that and acquire. There are a lot of stranded small cap companies in Canada, the Surges, the Obsidians. There should be a mash together, especially when there's the commonality of Baytex really as a special gift at identifying conventional heavy oil pools and new plays. they should be an active consolidator in Canada, increase their market cap to gain relevance. So on a strict, stock perspective, I think you could get into the high $4s to maybe $5. But at that point, they're going to have to do something from an M&A to increase because they have roughly 10 to 12 years of inventory. That's just not enough.
Okay, we're going to take a quick break. We will come back with a look at past picks from Eric. Stay tuned. Time now to have a look at Eric's past picks from November 21st of last year. At the time, Eric, you picked MEG Energy, MEG on the TSX, which was then acquired by Cenovus. At the time, last year, it was 26.73, went to 30.89, so 16% upside and 17% total return. There was a lot of back and forth in that deal before it finally got done. Were you happy with the outcome?
No, we were somewhat devastated by the outcome. MEG was such a special stock. I know gauging by share performance, viewers may not understand when I call it a cyclical low, but I think this company was put into play at a cyclical low, at least from a sentiment perspective. Adam Watrous, we've spoken a lot about on the show our views and such. I respect him enormously. I am just a little miffed at him that he put what was to be one of the best examples of what compounding meaningful share buybacks over time was going to get you. $30 might sound great. I thought this was a $50 stock in a more optimistic oil pricing. That would be like a $70 or $75 oil price, which I do not think is out of the realm for 2027. And so I think, unfortunately, some people have tripped over pennies on their way to dollars on this one. MEG is one of the reasons why the rest of the mid-cap sector in Canada has been doing well. There's been a bit of an M&A premium embedded in them. Also, you've seen the recycling of proceeds from MEG into names like an Athabasca and such. So, no, we were very much not in favor of this transaction. We were publicly opposed to it. We were unsuccessful at getting enough opposition to the deal, and we were happy to see it go into Cenovus's hands. Cenovus is a stock that we do own currently.
Okay, let's get to your next past pick from last November, ARC Resources, ARX on the TSX. At the time, it was 26.97, and now it's at 26.77. 1% downside, 2% upside, of course. Natural gas prices lower earlier in the year, now coming back a little bit. Have you held on to ARC?
We have. We've trimmed it slightly. ARC was always viewed as a very, very high-quality company, kind of a boring, sleepy board, that's a good thing. Very high-quality assets, lots of asset duration, et cetera. And they had a project that was coming on called Attachie. That was to be a very significant catalyst for the company. They experienced some teething problems with the boring viewers, but it didn't come on at the same rates and the same liquids weightings as what they had originally thought. And so they're kind of in the doghouse right now. They need to still prove the overall economics of the play. They're confident that the most recent pad that they drilled with the learnings of prior wisdom gained, that they have fixed the problems. But I think this is a market where they're really going to have to prove that to the street. We still see very good upside in the name, but with the knowledge that perhaps it lags for the next quarter until they come out with better well results. We would have the stock trading at a forward multiple of about 5.2 times. That's a bargain. We talked about Tourmaline earlier on. So ARC's trading at a discount. They are in the doghouse. They are in the penalty box. Should they be able to emerge from that, we would think a 7 multiple is appropriate for this name. That would be a target price in the mid to high 30s. Further, we do think there is a lot of potential M&A interest in Canada. This would be near the top of the list. If I was an acquirer, what I'm looking for is a very high quality asset, which for whatever reason is being temporarily impaired from a proper valuation. I can't think of a better example than this company. And so there is the prospect. I'm not hoping for it. I'm not hoping for any further consolidation, at least for the names that I own, going into next year, because we see very meaningful upside in all of them. But I would consider that a possibility. Okay,
let's get to your third past pick, Tamarack Valley Energy, TVE on the TSX. When you chose it last November, it was $4.57. It's come up to $7.77 today. 70% upside, total return of 74%. Did you hold this in trim? Do you still hold it?
We remain a very large shareholder. It'd probably be about a 8% weight in our funds. That would put us top 5 shareholder, I believe. Tamarack's just done a absolutely phenomenal job over the past 2 years. I would give Steve Bytel's the current former CF, and now he's the president, credit along with the current CEO to reposition the company into the most prolific, most economic play in North America called the Clearwater. They had the foresight to really attack it with water flooding. So that's just injecting water to increase reservoir pressure and increase recovery rates and production. And the results that they are getting are absolutely spectacular. You're taking wells that are, let's call it 50 barrels a day, and you're going to 500 barrels per day. The finding and development costs are just some of the most economic I've ever seen in my career. And so this company has done a phenomenal job. We still see a lot of running room left in this stock or in this company. They have 20 plus years of drilling inventory. It continues to trade at a fairly attractive multiple. We'd have it at a forward multiple of 5.5 times, despite the stock being up 70-ish% on the year. We think a fair multiple for this would be 6 to 7. So, again, that's probably conservative. And at the current oil price, that'd be about 20-30% upside from here. We're much more optimistic in the oil price over the next year or so. So were you to go from 60 to 70, you could squeeze out almost a $12 target, which is about, call it 55% upside from here. So this is a name, it's been tough at times because we've been somewhat cautious on oil. You look at inventories starting to grow more than they should be, counter-seasoning, et cetera. But there's only a few oil names that we own. This remains one of them.
All right, let's take another quick break. We'll line up more phone calls and emails for Eric Nuttall, Ninepoint Partners. Your questions today on energy stocks. Back in a moment. Welcome back to Market Call. Eric Nuttall with us today to answer your questions. Let's go to Paul. He's on the line in Squamish, BC. Hi, Paul.
Hello. Thank you for taking my call. I was wondering if I could get Eric's opinion on Birchcliff Energy.
Okay, thank you for the call. Go ahead, Eric.
Yeah, Birchcliff is fine. I had an update with the CEO, I would say 3-ish weeks ago. It's what I'm going to define as a smallish cap natural gas producer. They've got 20 plus years of delineated inventory with some exploration further to the south. They're again, similar to Tourmaline, pursuing a capex heavy program to grow production. They have idle capacity of a plant. So as you increase volumes, you're decreasing your operating costs. So you have to wait until, I believe it's 2029 for any semblance of free cash flow. They're also not hedgers. And so if you're bullish on natural gas, it can give you a reasonable upside to that. We'd have it trading at an inline kind of to their peers multiple of about 5 times forward cash flow. Again, very modest free cash flow post their dividend. I think they're yielding 1.6% right now. So that's kind of a stipend. Later on, I'll have a pick for you, which I think offers you more upside with a significantly higher dividend. And I would say equal quality inventory and probably more inventory depth. So it's not a name that we own. We've looked at it. We just didn't find it attractive enough at the time to buy it.
All right. That was for Paul. Let's go to Ray. He's in Ottawa with a question. Hi, Ray.
Hi there. Thanks for taking my call. I am invested in Canadian Natural Resources, thinking of adding some more possibly today. And I would like to know if you would be adding at this price. And I didn't get what you said earlier. Are you bullish on oil, WTI, for 2026 and beyond? Thank you.
Thank you for the question. Go ahead, Eric.
We're bullish oil. I don't think there's a lot of downside. I just don't think there's a lot of upside in oil over the next, let's say, 6 months. If you follow my work on Twitter, we put up charts showing global inventories using very expensive and valuable data using satellites. We're building more than we should be right now, and there's reasons for that. When I think about C&Q, this is a name that has done well relative to what oil has done. There's a few reasons for that. One is they also produce natural gas. People are more bullish gas. But it's also such a perceived and in reality of an extremely well-run company. Murray Edwards and his team, they're phenomenal. This is a very, very widely held stock. Again, if you're an advisor in Canada, if you don't own me for energy exposure, you own CNQ. I can almost guarantee that. And so it's a very, very widely held stock. As a result, as people get more bullish on oil, I think it will be a source of funds as opposed to a name where people will gravitate more towards because everybody's already there. And because of that, it trades at what I would deem to be a fairly full multiple. It's trading at 8 times cash flow using $60 oil. That would be our target multiple. It's got to attain the heights of an Exxon, which is kind of like the gold standard to get any more significant price appreciation if we're directionally accurate in oil. Second half of next year, you absorb some of the barrels that are floating around right now. You get past headline risk on Russia, Ukraine, headline risk on Venezuela. The world wakes up and realizes OPEC has very little spare capacity. U.S. shale growth is over. Non-OPEC production is peaking. That's when we turn bullish. And in fact, obviously, we'll be ahead of the curve, I think, on that. But CNQ, I just struggle with it at this price. It's done very well relative to a 19% drop in oil. As a consequence, its multiple has expanded. And I just struggle to see meaningful upside over the short term in it.
Interesting. Okay, let's go to Jean in Montreal. He's got a question today. Hi, Jean. Jean, are you there? Okay, we may have lost that caller. Let's go to Scott in Saskatoon with a question. Hi, Scott.
Good morning, Marilla and Eric. I was wondering if you could segue on your comments on Tamarack and their water flood and the Clearwater to any of the other Clearwater players and how water flood will impact them.
Okay, thank you for the question.
So Headwater is the other public name when it comes to the Clearwater exposure, at least of size and scale. It trades at a pretty material premium to Tamarack. I think one day it would make a lot of sense for these two companies to merge to gain size and scale, and you get synergies through a lot of different cost reductions. It would be trading on our math at 7.2 times forward. So I compare that to a Tamarack's 5.5. So that's a big spread. It kind of makes a merger somewhat challenging. So this is a name, again, you've got a $2.2 billion market cap, 4.8% dividend yield. It's still relatively small. The universe of potential buyers is as at least today, somewhat limited. So at that multiple, we actually have a negative upside from current levels at $60 oil. They've done a great job, just as Tamarack has, of focusing on the most economic play in North America. They're having a good success from a water flooding perspective. I would suggest Tamarack is far ahead of them in terms of figuring it out, just hitting it much harder and faster, and they're getting much better results. I would be a seller right now of Headwater, and I'd be buying Tamarack because I can't justify the spread in valuation. We do not own Headwater right now.
Okay, that was for Scott in Saskatoon. Let's go back to Jean in Montreal. I think we've reconnected. Jean, what's your question today?
Yes, it's on precision drilling. It caught my eye in the past month. Do you have it in your fund, or do you see more upside?
Okay. Yeah, we don't currently. We've owned it. I think we were their largest shareholder for a time, and we did well, and we actually sold quite well. I think we sold it because we were cautious in the outlook for oil, the likelihood of drop in the rig count and drilling activity, the likely drop in day rates. That all played out. The stock has had a heck of a rally. Part of it, I think, might be the enthusiasm around the potential sanctioning of phase 2 of LNG Canada next year. They'll have to drill a heck of a lot of wells to fill that. It could be that they've achieved their final debt target, or at least their ultimate debt target. So they're pivoting towards 50% rate of a return of capital, which is something we had kind of gone to the board and suggested well over a year ago. So they're there now. We would have it on our numbers trading at about a 20% free cash flow yields next year. That'd be the ability to buy back 10% of their stock. That's pretty compelling. Trades well at a EBITDA basis. We don't have any service exposure right now. I just don't see it being a dynamic where the service stocks do very well when they're actually traded at a very high multiple, because that tells you that you're at a cyclical low. This name kind of suggests to me that it's still not where I would want it to be buying it. We'd put a 5 multiple on it. Spreadsheet math would suggest meaningful upside. We're just not there right now when it comes to the conventional services.
All right, we will leave it there. We'll have more of your phone calls and your questions when we come back. Stay tuned. Welcome back to Market Call. Let's go to the phone lines. Thomas is on the line in Toronto. Hi, Thomas.
Hi there. Thanks for taking my call. I'm just calling about your opinion midterm on Imperial Oil. It's taken kind of a bit of a dip recently, and I noticed there was a few sell recommendations coming out on it. Thank you.
Thank you for the question. Eric, sort of give us a wider look at oil. I know we've talked about it a couple of times before. You're bullish on it. We've seen what happened with CNQ, but Imperial Oil looks like it trended up pretty much most of the year.
Imperial has been a spectacular performer, like just unbelievable. It was up, I think, at 1.70% of the year. It's one of my biggest mistakes this year was not owning it. In fact, that's true over the past couple of years. We're bullish on oil second half of next year. You know, every day is a new day. We just think we've got to get past headline risk on Venezuela, headline risk of Russia, Ukraine, and also get a little more confidence the market is better absorbing barrels that we can see with satellites. When we do that, okay, what do you want to own? You want to own companies of size, scale, inventory depth, generating a lot of free cash and then using that to buy back their shares. That's Imperial. They check off every single box. The only challenge is I think the stock price is already reflecting that. At $60 oil, we'd have a trading at 10 times cash flow. That's like a 50% premium to a name like a Cenovus. So if you own Imperial, like you've done very, very well. I'm not an accountant. I can't give tax advice. So you have to be wary of this with 3 weeks left in the year. But I would find a name like a Cenovus, which we do own in the fund, a lot more attractive. You'd be paying, let's call it 6 times versus 10. You've got positive rate of change from their downstream. I just don't really see the buy thesis here on Imperial when you're already paying a 10 times multiple and a 5% free cash flow yield. Like it's been a beast. It's been a massive mistake not to own it. I have no idea why the incremental dollar would go there versus other names.
Okay. Thomas, I hope that works for you. Let's go to an email from Roger. He says, could I get Eric's views on Transocean and in general offshore oil and what kind of growth he sees in the next 2 to 3 years? So they do obviously offshore drilling.
They do.
Where do they drill?
All over. Like okay. They're the largest offshore driller. They're the only company that did not go bankrupt through the COVID lows. So as a result, they do have a little more debt than their peers. It's manageable. The stock's down today. I think JP Morgan downgraded it on worries that they do have exposure to Petrobras. Petrobras has been cutting back their CapEx program, which is good for the macro, by the way, but it just gives them a little less tension. We bought Transocean pretty in size on a equity deal down, I think it was $3.15. Stock ripped. We were cautious on oil, as I've noted. We thought we were doing well to sell it around $3.80, $3.90, and it touched $4.50 not that long ago. This is a name I would look to re-enter, not today, likely lower. We do think in a world where demand is going to grow for the next several decades. We just had the biggest bear in the world, the IEA pivot, and they turtled and they said, we was told you peak demand was right around the corner. Well, in fact, it's going to grow to at least 2050. Where are the barrels going to come from? They've come from U.S. shale. That growth is over. And so we live in a post-U.S. shale world, which means you've got to satisfy demand growth from going offshore. And so the macro is very, very, very in Transocean sales. We just have to get through the next 3-6 months and get a little more visibility, I think, on what day rates and contract renewals would look like with some of their key customers. But it's a name that we're, in terms of the entire services spectrum, it's probably one of the ones that we're most positively inclined to own.
Interesting. Okay, let's go to another email then from Sean, who says, for Mr. Nuttall, do you like Prairie Sky, Eric?
Yeah, Prairie Sky is a stock that has struggled this year. I think one of the reasons is it has been a strong performer over the past several years. So it was already trading at a fairly high multiple. At a time earlier this year when we were suggesting freehold, it was trading at twice the multiple. So it would be trading now at a 19 times forward multiple on our estimates. I've always kind of struggled with this theme, like, well, what's the right multiple? Like, you can't use free cash flow yield because it's very, very low. You clearly, to use a cash flow multiple, I've got to be thinking about like Franco-Nevada. It yields 3.8%. To me, that's not overly compelling. They do have extraordinarily good exposure to the Clearwater. Andrew Phillips and their team they've done a really, really great job at identifying resource early stage and then acquiring acreage and then leasing it out. I love the royalty model because you're the first one to get paid and you're paid off the top. I struggle right now to say, okay, what's a fair multiple? We always kind of had 20 times in our head. That would give you about 10% upside. So that doesn't do it for us.
All right, let's leave it there for questions. We will be back with new top picks from Eric. Stay tuned for that. Join us tomorrow for Market Call. Bruce Campbell will be with us on the show. He is president and portfolio manager at Stonecastle Investment Management. He'll take your questions on Canadian stocks. That's tomorrow. Let's get to new top picks from Eric Nuttall. We begin with Whitecap Resources, WCP on the TSX. What do you like about Whitecap? And Eric, also, I want to ask you, you mentioned relevancy for shareholders, and there's a cutoff, I'm sure, for what you find relevant. What does that look like?
In my mind, to be attractive to the largest institutions in Canada, the United States, and elsewhere, I think you need a market cap of about $10 billion. Whitecap ticks that box off. Given their merger with Veren earlier this year, they now have a $14 billion market cap, and so you're now suddenly much more relevant to large institutions. We're bullish on oil for the second half of next year. We do think that oil will remain range bound, and so it's important if you're looking for oil exposure to find names that they can get re-rated for a variety of reasons, and they don't need the oil price to go up. Whitecap 2 checks that off. They have beaten and raised their guidance for many quarters in a row now. They made an excellent acquisition with Veren. We were one of the largest shareholders of Veren. We remain a very significant shareholder now of Whitecap. It trades at a discount to its peers, even though by our estimates, they have at least 25 years of stay-flat inventory, and that's very good inventory. And as I mentioned, you are seeing an significant increase in investor attention from the United States, where with the twilight of U.S. shale, you need to go into areas which are not fully mature. That is the Montney, that is the Duvernay. Whitecap has significant exposure to both of those plays. And so with 25 years of stay flat, a 6.3% dividend yield, and a stock that's trading at only 5 times forward cash flow at 60, we think a fair multiple is 7 times. And so at $60 oil, that would give us about a $19 target price. That'd be 65% upside. If you dare to dream in a world in 2027 where, with the twilight of U.S. shale, the loss of that incremental barrel, ongoing demand growth, and the normalization of OPEC spare capacity, we do not think that $70 is out of the realm. And at 70, we would get a $23 target price, which is about 100% upside from here.
Okay, let's get to your next pick, which is Expand Energy, a natural gas play. They're out of Oklahoma, EXE on the New York Stock Exchange. And what do you like about Expand?
Yeah, so Expand is North America's largest natural gas producer. They produce about 6% of total volumes. But importantly, their production is closest to the areas of demand growth. They're in the Haynesville, that's in Texas, so they're very close to U.S. LNG. They're also in the Marcellus, which is close to where a lot of data centers are being built. So as a consequence, they're getting a premium price for their natural gas. We think they have at least 20 years of stay-flat inventory. And from a free cash flow perspective, because they're a U.S. energy company, energy is only about 2.7% of the S&P 500. That is very irrelevant for an investor down there, where they could spend more time, as much time on Microsoft as they could for the entire energy sector. That's offering a huge opportunity in these stocks that are mispriced. Expand's trading at about 11 to 12% free cash flow yield at $4 gas. $4 gas happens to be the strip for next year and almost in 2027. It's also what we think is the marginal cost of supply. And so if you're a commodity investor, you want to buy into a sector that is out of favor, a sector that is gushing free cash flow, and a sector where the commodity is trading at the marginal cost of supply, that should be the floor price. That is what you get with Expand Energy. If we have an ongoing continuation of even normal weather, we see the possibility of gas heading to $5. At $5, this company's free cash flow yield would almost double. You'd go from about 11 to 12% free cash flow yield to about 21%. So theoretically, they could then privatize themselves with just 5 years of free cash flow, and you'd be getting 15 to 20 years of inventory for free.
Okay, let's get you your last pick, which is Peyto Exploration, PEY, on the TSX, currently trading at about 22.50 is where I have it. What do you like about Peyto moving forward?
Yeah, Peyto is our favorite Canadian natural gas producer. We do prefer exposure to the United States, but we've maxed out those positions. So that brings us to Canada. Within the Canadian realm, what we like about Peyto is they have what we believe is 20 years of booked drilling inventory. They then have, we think, another 20 years of unbooked drilling inventory. So you've got 40 years roughly of stay flat inventory. The yield is quite attractive to us, a 5.9% dividend yield. They've compressed that meaningfully this year because the stock has done so well. They acquired land from Repsol earlier this year, and they really stole it. We do have experience in stealing assets at depressed pricing from the majors who have been leaving Canada. Repsol decided to leave Canada, and they sold assets, extremely good quality assets, to Peyto at a song. So as Peyto continues to delever, we see them increasing their dividend by 20 to 25% around the second half of next year.
Okay. Eric, I've got to leave it there. We are out of time here on Market Call. Thank you very much for joining us. We'll see you again soon.
My pleasure.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.